Today in this video we will take a new topic in which the revised value of assets and liabilities will not be recorded. In the previous video we have solved a few questions where the revised value of assets and liabilities were recorded in the balance sheet. Here we will not record the revised value, and the adjustments will be done through an adjustment entry with the help of partners capital account. Revaluation of assets and liability, and in that the revised value of assets and liabilities will not be recorded in the books. We have already discussed this topic, that at the time of reconstitution of firm, partnership firm, the value of assets and liabilities recorded in the books and the realizable value of these assets may differ, and at the time of change in profit sharing ratio of existing partners, no partner should stand at loss or profit, so it becomes necessary to record the revised values. Okay. And if there is any profit or loss, it will be shared by the partners in their old profit sharing ratio. Okay. And it can be given the effect in two ways. First, when revised value of assets and liabilities are recorded in the books, which we have already discussed in the previous video, and second, when revised values are not recorded in the books. Okay, when revised values are not recorded in the books, what we will be doing, we will pass an adjustment entry with the help of partners capital account. Okay, in the working note we will prepare a statement calculating the net effect of revaluation and reassessment of liabilities. Revaluation of assets and reassessment of liabilities effect we will take, and that effects adjustment will be done through the partners capital account. Following steps are taken. Okay, now if increase in the value of asset is there, it will be added. Decrease in the value of asset will be deducted. In the same manner, any decrease in the value of liabilities will be added, and increase in the liabilities will be deducted. Then we will calculate the gaining ratio and sacrificing ratio. Then we will calculate the proportionate amount of net effect, like whatever profit is there, it will be multiplied with the gain ratio and sacrifice ratio of respective partners. Then, like, the gaining partner's share will be calculated by multiplying his gained share with the net effect of revaluation. In the same manner, sacrifice partner share will be calculated by multiplying the sacrifice share with the net effect of revaluation. And last, we will pass the journal entry, where gaining, in case of, if the net effect is profit, then the gaining partners capital account will be debited and sacrificing partners capital account will be credited. And in case of loss, sacrificing partners capital will be debited and gaining partners capital will be credited. Okay, all of you, first we will calculate the net effect of, again I am repeating that, all the steps. First step is we will calculate the net effect of revaluation. Increase in the value of assets and decrease in the value of assets will be added, whereas decrease in the value of asset and increase in the value of liability will be deducted. So net effect, if it will be either profit or loss on revaluation. Okay. Then we will calculate the gaining ratio and sacrificing ratio. The formulas are very simple. In case of gaining ratio, it is new ratio minus old new share minus old share, and in case of sacrificing ratio it is old share minus new share. Okay, then we will calculate the proportionate amount of net effect. For gaining partner, gained share will be multiplied with the net effect of revaluation, and in the same manner sacrificing partner share will be calculated by multiplying his sacrificed share with the net effect of revaluation. And the fourth step, we will pass journal entry. If the net effect is gain, profit is there, then gaining partner will be debited and sacrificing partner will be credited. And in case of loss, sacrificing partner will be debited and gaining partner will be credited. Now let's take one illustration. There are two partners P and Q, and they are sharing profits in the ratio of 3:2, and in future they decide to share profits equally. Okay, and they have decided that the revised values will not be recorded in the balance sheet, and to bring the effect of revaluation, adjustment entry will be passed. Now see, the building's value is given, book value is 4 lakh and revised value is 5 lakh rupees. Creditors, it's 80,000 and then it has reduced to 70,000. Stock, from 70 it has reduced to 50, and in case of outstanding expenses, from 20 it has increased to 30,000. So we have to pass one single journal entry. In case of building, there is a profit of 1 lakh. Creditors, there is a gain of 10,000 because liabilities are decreasing, so it's a gain, we will consider it as profit. Then stock, asset is decreasing, so loss. And then in case of outstanding expenses, it is increasing by 10,000 rupees. Okay, so we will deduct that. See the statement. So first we have calculated the sacrifice. A sacrifice is old share minus new share, 3/5 minus 1/2, it is 1/10. Okay, in the same manner B is gain, B is gaining 1/10 of share. So we will calculate the net effect of revaluation. Increase in the value of building will be added, and decrease in the value of creditors will be added, and decrease in the value of stock is deducted, and increase in the value of outstanding expenses is deducted. So net effect of revaluation is 80,000 rupees. There is a gain. Okay, so now proportionate amount we will calculate. So 1/10 of 80,000 is 8,000. Here B is gaining, A is sacrificing, and there is gain on revaluation. So B's capital will be debited. 1/10 of 80,000 is 8,000 rupees to A's capital, 8,000 rupees. Okay, again I am discussing this point. See, to first we will find out the gaining and sacrificing ratio. Here A is sacrificing 1/10 of his share, 1/10 of share, and B is gaining 1/10 of share. Net effect of revaluation is there is increase in the value of building, so it will be added. Decrease in the value of creditors, liability is decreasing, so it will be added. In case of stock, it is decreasing by 20,000, and in case of outstanding expenses, it is increasing by 10,000. So the net effect is profit of 80,000 rupees. When there is profit, the gaining partner will be debited and sacrificing partner will be credited by the proportionate amount of gain. So 80,000's 1/10 is 8,000 rupees. So B's capital will be debited and A's capital will be credited by 8,000 rupees. Okay, and then the narration, adjustment of entry for revaluation of assets and liabilities. There are a few questions like this in our book. Please practice them. Any doubt, you can send the message to me.